Tesla has made price cuts a familiar headline over the last couple of years, and the Model Y, America's best-selling EV for long stretches, has been right in the center of it. For shoppers, lower sticker prices can feel like a win. But for many current owners, especially people who bought recently, these reductions can create a quieter, more personal problem. The value of the car can fall faster than the balance on the loan. That gap is what the industry calls negative equity, and it's where the biggest hidden losses are showing up. Tonight, we're breaking down who actually loses the most when Tesla cuts Model Y prices, who is largely unaffected, and why, right now, new buyers can be stepping into the same vehicle with less financial risk than people who purchased just months earlier. To understand the impact, you have to start with what a price cut really does. It doesn't just lower what a new buyer pays today, it also resets the market's reference point for used values. If a brand new Model Y gets cheaper, buyers shopping used will expect a discount from that new price. Dealers adjust trade-in offers. Private party buyers negotiate harder, and the resale floor drops, sometimes quickly. Even owners who never plan to sell can feel it when they look up their trade-in quote, or when their insurance company calculates payouts based on actual cash value after a loss. And it's not only the sticker price. Tesla has also used incentives like discounted inventory cars, temporary financing promotions, and other point-of-sale moves that can effectively lower the real transaction price further. The result is the same. The used market recalibrates. So who gets hurt the most? The owners most exposed are the ones who bought recently, typically within the last year or two, financed a large portion of the purchase, and put little money down. If you combined a low down payment with a longer loan term, like 72 or 84 months, you start the loan with a balance that barely falls in the early months, while the vehicle's value can fall quickly. Price cuts accelerate that mismatch. Here, why it hits so hard. A new car's depreciation is steepest early on in most cases, and EVs can be especially volatile because technology evolves quickly and incentives can change demand overnight. If on top of normal depreciation, the manufacturer drops the new car price, the used value can take an additional step down. That can push a recent buyer into negative equity even if they've made every payment on time. And it's not just one category of buyer. This is especially painful for three groups. First, the low down payment buyer. If you put zero down or close to it, your loan balance starts near the total out-the-door cost. And out the door is bigger than many people think. It's the vehicle price plus taxes, registration, documentation fees, and sometimes add-ons. If you rolled any extras into the loan, wheels, paint protection, accessories, service plans where applicable, that's more balance. At a high interest rate, and early payments go more toward interest than principal. When the car's value drops, you can end up owing significantly more than the vehicle is worth in the open market. Second, the buyer who traded in a car with negative equity. If you were upside down on your prior vehicle and rolled that balance into the Model Y loan, the math gets harsher. You didn't just finance the new car, you financed old debt too. That can put you underwater from day one. A price cut then makes climbing out of that hole take longer. Third, the buyer who paid a peak price or bought right before a price drop. Timing matters. A buyer who took delivery shortly before a major reduction often sees the sharpest paper loss because the market immediately anchors to the new lower price. In practical terms, you may have paid thousands more for a similar configuration than someone buying today. It can feel personal even when it's not. The market doesn't compensate you for buying earlier. Now, does that mean everyone who owned a Model Y before a price cut is losing? Not equally, and sometimes not in a way that matters day to day. A lot depends on how you bought the car and what you plan to do with it. Owners who are largely unaffected usually fall into one of these categories. 1. Long-term keepers who plan to drive the car for many years. If you intend to keep your Model Y well past the loan term or you own it outright, a short-term change in resale value may not affect your life at all. The car still gets you to work, still carries the family, still does the job you bought it to do. Depreciation only becomes a real cash loss when you sell, trade, or total the vehicle and have to reconcile its value with what you owe or expected to get. 2. Owners who put a large down payment or paid cash. If you paid cash, you may see the car's market value drop on paper, but you're not at risk of negative equity. If you put enough down, you created a buffer between the loan balance and the vehicle's current value. That buffer matters. It reduces financial stress and gives you options if you need to sell. 3. Owners who bought earlier and have already paid down a meaningful portion of the loan. If you purchased years ago, your balance may now be low enough that even with price cuts, you're still above water. The market can move against you and it can still sting, but you're not trapped. 4. Some lessees, depending on contract terms. Many leases set a residual value at the start. If market values fall below that residual, the lessee is often insulated because they can simply return the vehicle at the end of the lease, assuming they stay within mileage and condition limits. The risk shifts more to the lessor. But there's a catch. If you want to get out early, or if you plan to buy out the lease and the buyout price is higher than market value, then price cuts can still affect you. It's not a blanket protection, but for many people, leasing can reduce the pain of sudden used market declines. Now to the third question: new buyers versus old buyers, who is actually winning right now? In simple terms, new buyers are often entering with less downside risk because their purchase price is closer to the current market clearing price. That doesn't guarantee future resale, but it reduces the chance they immediately become underwater. It's the difference between buying at yesterday's price and buying at today's price after the reset. New buyers can also structure the purchase with what the last wave of buyers didn't have: more information and, in some cases, better deal options. They've seen the volatility. They may be more cautious. They might put more money down, choose shorter loan terms, or shop insurance more aggressively. They can also compare Model Y pricing with a fast-growing field of competitors and negotiate accordingly. But the win for new buyers isn't only the lower sticker. It's the reduction in financial fragility. If you're buying now at a lower price and you finance responsibly, meaning a reasonable down payment, a manageable term, and a payment that doesn't stretch your budget, you're less likely to be forced into a bad decision later. That's the key. The biggest losses usually get locked in when people are forced to sell at the wrong time. And that brings us to what smart owners are doing right now to avoid turning a paper loss into a real one. First, they're not panic selling into a weak moment unless they have to. If you sell right after a price cut, you're selling into a market that has already repriced downward, and you're doing it when buyers have leverage. If you're underwater, selling also means you have to bring cash to the table to pay off the loan, or roll negative equity into another vehicle, which can extend the problem. Second, they're checking their real numbers, not vibes. That means getting an actual payoff quote from the lender and comparing it with multiple market value estimates. Not just one online estimate, several. A trade-in quote from a dealer, a quote from a car buying service, a realistic private party range based on listings that are actually selling, not just posted. The goal is to know where you stand today, because "I think I'm fine" and "I'm fine" can be very different. Third, owners who are underwater and need flexibility are looking at gap insurance and coverage details. If you financed and did not put much down, gap coverage can be crucial because it can cover the difference between what your insurer pays after a total loss and what you still owe on the loan. Some buyers already have it through their loan or insurer. Others don't. The right answer varies, but the important point is understanding whether you'd be financially exposed in a worst-case scenario. Fourth, they're avoiding the temptation to refinance into longer terms just to lower a payment, unless there's a compelling reason. Stretching the term can keep you in negative equity longer. Sometimes refinancing at a lower rate can help, but it depends on the rate, the term, and the fees, and whether you're extending the debt timeline. Fifth, they're driving the car longer and paying down principal faster when possible. Even small extra payments directed toward principal can shorten the time it takes to get above water. This isn't glamorous, but it's effective. The more quickly your loan balance falls, the less power market volatility has over your options. And sixth, they're being careful about rolling negative equity into a new purchase. That's a big one. If your Model Y is underwater and you trade it in for another vehicle without addressing the gap, you can start the next loan already behind. That's how people get stuck in a cycle, especially when prices and interest rates are moving targets. Now, there's another part of this story that doesn't get enough attention. Not everyone experiences the same market because not every Model Y is the same asset in the eyes of buyers. Trim, configuration, mileage, condition, and even region can change how hard a price cut lands. Higher mileage vehicles feel depreciation more. Heavily optioned configurations can lose more because the used market doesn't always pay back the original premium. And regional demand can swing based on charging access, weather, and local incentives. Also, timing matters around incentives. In the US, for example, eligibility for EV tax credits can change based on rules and supply chains. When a new car effectively becomes cheaper because a buyer qualifies for a credit, the used market has to compete with that reality. If a buyer can get a new Model Y at a reduced effective cost, they're less likely to pay top dollar for used. That can compress used values even if Tesla doesn't change MSRP. So what about owners who say, "I don't care, I'm still saving on gas"? That can be true at the monthly budget level. Fuel and maintenance savings can be real, especially compared to higher-cost vehicles. But it's important to separate operating cost from asset value. You can save money on fuel and still lose money on depreciation. Whether that matters depends on your time horizon and whether you plan to sell or keep. A good way to think about it is this. If you keep the car long enough, depreciation becomes the cost of using the car over time, similar to rent, just paid through lost value rather than a monthly bill. If you sell early, depreciation becomes a more immediate hit because you crystallize the loss when you exit. Now, let's talk about why Tesla does this, because it shapes what owners should expect going forward. Tesla's pricing strategy has been unusually dynamic compared with traditional automakers. Instead of doing slow, model-year-based adjustments, Tesla can change prices quickly and broadly. The company has used pricing to stimulate demand, manage inventory, and respond to competition and economic conditions, including interest rates. When borrowing costs rise, monthly payments rise, and demand can soften. Cutting price can keep payments closer to what buyers can tolerate. That strategy may be good for unit sales in the short term, but it carries a trade-off. It can undermine resale confidence. For some consumers, the fear is not just, will Tesla cut prices again? But how do I plan a major purchase if the price can change sharply after I buy? That uncertainty can push some people toward leasing, toward other brands, or toward waiting. And that waiting behavior can create a feedback loop. If consumers expect future price cuts, they delay. To pull them in, the manufacturer may cut price again or offer incentives. That's not guaranteed, but it's a pattern markets have seen in different forms. So if you're watching this story as a current owner, what should you do? The first question is whether you actually need to make a move. If you're comfortable with the payment, you have gap coverage if needed, and you plan to keep the vehicle, the best decision may be to do nothing. The market value is what it is today, but it doesn't become a real loss unless you sell, trade, or total the car. If, however, you think you may need to sell in the near term, job change, new baby, moving, cash flow issues, then it's worth running the numbers now rather than later. If you are underwater, you can plan for it. Increase payments where possible, reduce other debt, or set a timeline to exit when the balance is lower and market conditions are better. If you're a potential buyer, the main lesson is to buy for stability, not just for the deal. That means thinking about down payment, term length, and how long you plan to keep the car. If you want flexibility, don't structure the purchase in a way that assumes resale will bail you out. Build in a cushion. Don't treat the lowest monthly payment as the goal, treat it as a constraint within a bigger plan. It also means understanding that Tesla's price today might not be Tesla's price next quarter. That doesn't mean you should never buy. It means you should decide based on whether the car fits your life and whether you can afford it even if the market moves against you. And if you already own a Model Y and feel like you're losing money because of price cuts, remember, the biggest financial damage often comes from being forced to act at the worst moment. Owners with low down payments and long terms are the most exposed because their choices narrow when values drop. Owners with strong equity, through bigger down payments, shorter loans, or simply time, have options, and options are what protect you. This is why the same price cut can create completely different outcomes. For a new buyer, it's a lower entry point and potentially less risk. For an owner who bought at a higher price with minimal down payment, it can mean months or years longer before the loan balance and the car's value meet again. For a cash buyer who plans to keep the vehicle, it might be little more than a frustrating headline. And the bigger takeaway tonight is that these aren't just car enthusiast issues. This is personal finance. When prices move quickly, the fine print of how you finance the purchase becomes just as important as the vehicle itself. As this market continues to evolve, with competition increasing, incentives shifting, and interest rates changing, Tesla's pricing decisions will keep affecting not only new sales, but the financial reality of millions of owners already on the road. And if there's one thing owners and buyers can do immediately, it's this. Know your equity position, know your payoff, and don't let a fast-moving market force you into a slow-moving debt problem. For anyone making a decision soon, buy, sell, or hold, the smartest move is to treat the Model Y not just as a vehicle, but as a financial commitment whose risk rises or falls based on timing, loan structure, and how quickly the market decides your car is worth less than what you owe. That's the real story behind the price cuts, and who actually loses most. Not necessarily the loudest voices online, but the owners whose financing left them no room for the market to move.